All right, welcome to Talk Tickers. Today, we're diving into a really interesting one. The Q1 earnings report from John B. Sanfilippo & Son. That's ticker JBSS. Look, this wasn't just another earnings report. This was the kind of quarter that really turns heads on Wall Street. So let's get right into why.
And turn heads it did. I mean, just look at that number. The stock absolutely blasted up over 15% after they dropped their results. So the question we've all got to be asking is, what on earth did they say to cause a jump like that? That's exactly what we're going to unpack right now.
Okay, so it all kicked off with the headline numbers, and boy, were they good. We're talking a clean, solid beat on both the top and bottom lines. Earnings per share, $1.59. The street was looking for something around $1.37, so they just crushed that by 22 cents. And revenue, almost $299 million, when everyone was expecting closer to $274 million. I mean, that's a nearly $25 million beat. This right here was the rocket fuel.
But here's the thing, beating the numbers is one thing, but the real story, the one that gets savvy investors interested, is how they did it. This wasn't some flashy high-growth narrative. Nope, this was a story about just plain, good old operational discipline, and that's what we need to dig into.
And this right here is the key, gross margin expansion. Look at that jump, from 16.9% up to 18.1% in just a year. So how'd they pull that off? Well, it was really two things. First, they got smarter about pricing, making sure their prices actually reflected the rising cost of nuts. And second, there was this one-time price cut they gave a customer last year that, didn't happen again this year. You put those two together and boom, profitability just took off.
So let's break down exactly what levers they pulled to make that happen. First up, pricing power. They managed to raise their average selling price per pound by almost 9%. That's huge. And at the exact same time, they were getting costs under control. Their operating expenses, as a piece of their total sales, actually fell. Pretty significantly, in fact. Why? Because they spent less on things like marketing, warehouse space, and shipping. It's that beautiful combination, right? Higher prices coming in, lower costs going out. A classic 1-2 punch.
Now this is where it gets really interesting, because this was really a tale of two different businesses. If you only looked at their consumer channel, the stuff you and I buy in the store, you'd see that volume was actually down about 5%. You might think, that's not great. But wait, look at their other businesses. Commercial ingredients, that's them selling nuts to other food companies, that was up almost 13%. And contract manufacturing, where they make stuff for other brands, that just exploded, up over 18%. So all that strength in their B2B side more than made up for the weakness on the consumer side. It completely masked it.
Okay, so let's shift gears and talk about management's playbook here, because the way they communicated this quarter was, well, it was fascinating. You had this really interesting balancing act going on. On one hand, they were saying, hey, things are tough out there. But on the other hand, their actions were screaming confidence.
So, here's the cautious side. They literally came out and said that keeping up this level of earnings all year, well, it might be challenging. They pointed to the tough economy, the fact that the whole snack category is a bit weak right now. Basically, they were telling Wall Street, don't get ahead of yourselves. It's classic expectation management, right? Underpromise, overdeliver.
But then they did this. While they were talking cautiously, their actions were saying something completely different. They announced a $1 per share special dividend. Let me tell you, companies do not, I repeat, do not hand out that kind of cash unless they are incredibly confident about the money they're making and will continue to make. Actions really do speak louder than words here.
So, when you put it all together, what's the big picture? What's the strategic story? It's pretty clear, actually. This quarter was no fluke. This is a company that's using its balanced portfolio. I mean, they've got their own brands, they do private label, they sell ingredients, they manufacture for others. They're using all of that to build a really stable business. The game plan is simple. Execute well, focus on margins, and when you have extra cash, give it back to your shareholders. Okay, but to really understand just how good this quarter was, we have to zoom out for a second. We have to look at the bigger picture, because in investing, context is absolutely everything.
And this is why that context is so important. Look at this. Before this earnings report, JBSS stock was getting hammered. It was down over 21% in the last year. Now, to be fair, the whole consumer staples sector was having a tough time, down 5% itself. But even so, JBSS was lagging. So for them to come out and deliver a quarter this strong in this kind of weak environment, I mean, that's the kind of thing that can signal a major turning point for a stock.
All right, so that brings us to the big finale, the next call. We've gone through the numbers, we've talked strategy, we've put it all in context, so now the most important question. What does this all mean for the stock from here on out?
And this really is the million-dollar question, isn't it? After a stock jumps 15% in one day, a lot of the easy money has already been made. So do you chase it? Is there more room to run? Or was that the whole move and it's time to cash in your chips?
Okay, let's look at the investment thesis from both sides. The bull case, well, it's pretty straightforward. It's that they just keep doing what they're doing. They keep that pricing discipline, they keep costs in check, and those awesome B2B channels just keep growing. Simple. The bear case, on the other hand, is that the consumer side gets even weaker, or worse, that the cost of nuts starts rising so fast they can't raise prices to keep up, and all those beautiful margins we saw start to shrink.
So, where do we land? Here is the official Talk Tickers verdict. For the next quarter, we think they can keep those margins strong, but that overall volume growth might cool off a bit as the comparisons get harder. For the stock itself, we'd expect it to trade sideways for a bit, kind of digest this huge move up. But here's the bottom line for us. The improvements they've made to the business are real and sustainable. And for that reason, we're giving this an outperform rating. We believe they're positioned to continue beating expectations as long as they keep executing this well.
And of course, just a reminder, this is not financial advice.